First of all, thank you for the invitation. Not only it's a pleasure and privilege to be here with you, I'm also a strong believer in a dialogue between the industry and the regulators or supervisors. So I think this 17th edition of FIAR is a perfect opportunity for such a dialogue. Within the context of EIOPA, to tell that my friend Alexandru Ciunchan is a member of the stakeholder group and institutionalized dialogue between various stakeholders. What I will try to convey to you today is a brief update or an overview of what are the current recent EU regulatory developments. I apologize in advance if I'm repeating something which you all know, but I will put some light from my personal perspective on it. And I would also like to share with you Slovenian experience in implementing those developments, or what are our Slovenian views as full members of the EU, as Romania is also. So, briefly, the main topics which I'm going to tackle with are Solvency II, state of play, where are we now, what are the current challenges in this respect, IMD2, of which we are more or less dreaming to come into force, PRIPS, which have an important impetus right now, and EIOPA, which is perhaps the biggest regulatory challenge within European Union. Solvency II. As it has been already mentioned today, the final definitive date is the 1st of January 2016. So we do not expect this date to change anymore. We are now in a preparatory phase. Basically, all the European Union, I'm sure also Romania, is preparing, the industry is preparing, the supervisors are preparing, everybody is preparing for the entry of Solvency II, because really this is a completely new paradigm in our insurance universe. In this respect, EIOPA has adopted a guideline, which is basically a because the guidelines as a tool within EIOPA regulation has been meant for completely different purposes. I personally see the preparatory guidelines as an organized step forward into convergence because of the delays of the entry into force, formal entry into force. The preparatory guidelines, basically they contain a comply or explain process, which is addressed to all the supervisory authorities of the member states. Basically, they have to either to comply with the guidelines or explain whether they are going to comply or they are not going to comply. In this respect, I'm speaking now as the head of the supervisory authority in Slovenia. We don't have a problem. We absolutely don't feel pressed to comply with all the guidelines. We just choose which are the most important for our industry, for our market, that should be implemented beforehand. And my final point about preparatory guidelines is they should be viewed that they are addressed to the industry, regulators. The regulators will know what is contained in the Solvency II system. The industry should, the preparatory guidelines basically show to the industry what will be expected of the industry within the system of Solvency II. So this is an important thing. At least on our market, we have trouble with the industry understanding this point. Talking about solvency from a, I would say, more philosophical perspective or theoretical perspective, in my personal view, we are talking here about the leap of faith. We are going from a very strict regime of supervision into a much broader-minded regime of supervision. The basis of Solvency II, as you all know, is that all the risks facing an insurer should be taken into account in its business operations. And if we are talking about all risks, we have to admit that insurers themselves are in the position to know the risks they are facing best. We cannot fool ourselves that we, as the supervisors, are in a better position to know the risks. It is the insurers themselves which should recognize the risks and basically adapt their business model to the risks they are facing in terms of capital, in terms of system of governance, in terms of all other business processes within the insurer. And ORSA as the own risk and solvency assessment is the prime example of it. We are now, on Slovenian market, we are in dialogue with the industry, assessing whether they are preparing their ORSAs in the companies. We have an answer that 70% of the industry is prepared, is in the process of preparing ORSA and will be finished in this year. ORSAs of different companies are very different. What we are looking for as the supervisor is whether the management of the company understand their ORSAs, whether they can really identify with the risks they have been identifying through ORSA process. And what is most important, if we are talking that the insurers themselves are basically should be managing the risks and should be responsible for identifying and managing the risk, the most important part, at least from my perspective in Solvency II, is the system of governance. I think this presents the biggest leap forward in thinking, in mentality of the risk-based system. One of the major or the most important parts of the system of governance within Solvency II context is the 4 key functions. I'm talking about actuarial function, internal audit, risk management, and compliance function. And our approach in Slovenia is basically that we see the 4 key functions, not that they are covering different types of operations within the company, but basically that one business process, one business event should be viewed, should be supervised by all the 4 key functions, each tackling its own risks. I'm going to give you an example. An insurer is dependent on an external sales network, which is basically covering 50% of its production, an important part of its production. And because of it's such an important sales network, the insurer is basically devising or designing a special product for this network. The actuarial function will basically check whether the pricing of the risk for this special product is correct, is okay, is viable, is sustainable. The compliance officer, the compliance function, is going to check the licensing, the proper disclosures by this external network. The compliance function will prepare the due diligence process in this cooperation with the external network. Risk management function will calculate the concentration risk because of such material dependence on outside, on external network. And the internal audit, I'm sorry, here is a mistake on the presentation, will basically check the business process and the risks arising out of it. So basically, one business event, one business operation, the conclusion of the contract, of the agreement with the external network will be checked from different focuses, from different key functions. I think this is important, at least for our market. We had a trouble to understand it, to be completely honest. The big challenge of Solvency II, everybody is talking about it, everybody is understanding it in theory, but it will kick in on the 1st of January 2016. What will we do after the New Year's party? First of all, industry is responsible that it is prepared. This should be taken as a given. Second, at least in our case, there was a question of proportionality. We solve, in this respect, basically, we will not apply any proportionality on our market. We see small insurers as the same, that basically the clients of the small insurers should be provided with the same level of protection as with the big insurers. Basically, there should not be any discrimination because of the size. For us as the supervisors, the preparation for Solvency II is basically a systemic risk. We don't want to wake up on the 1st of January 2016 with non-compliant market as a whole. That's why we introduced an organized system of monitoring how the preparation in the industry is developing. Basically, we are asking for the reports, quarterly reports on how the industry and each and every participant on the market is preparing, what is its process, why are they lagging behind. How to do this monitoring? We have had a long debate whether to put it in the law, or we have enough authority as the supervisors that we basically force insurers into it. So far, so good. We didn't have to put it in the law. We have a reasonable and respectful relationship with the industry, and basically they are following what we ask of them. And as I said already, it's very important to monitor the advance. Going to the second part of the insurance regulation, which is very important. Solvency II, mostly it's about prudential supervision. It's about prudential risk-based system. The second part of the regulation, which is very important, is of course market conduct or consumer protection in a direct sense. And here I'm talking about the Insurance Mediation Directive 2, which has been in preparation for years and years. It's very important that we can hardly talk about single market in the insurance in general if the main distribution channels are not yet at the regulation of the main distribution channels is not yet at the appropriate level of unification. IMD2 is key to the consumer protection in the field of insurance. Basically, the consumers should be provided with the same level of protection also on the market practices in all the EU members. And the problem is that IMD1, or Insurance Mediation Directive 1, which is now in force, its implementation varies widely among member states because basically it lacks legal clarity. If we are talking about the paradigm or doctrinal approach in the regulation of sales channels, we should not underestimate the regulation of the sales channels. Now I'm talking from Slovenian experience. Because we are not talking only about the market conduct or the regulation or how the salespeople should behave vis-a-vis direct clients in their contacts with the insureds, with the policyholders, which of course is very important. But it can also have prudential consequences. Basically, it can materially affect the solvency position of the insurers, bad market practices. In this respect, I would like to emphasize the work done by the International Association of Insurance Supervisors, IIS, which has established a market conduct subcommittee, and basically they are evaluating, or we are evaluating, I'm also a member, the market risks which are arising for the insurers on the solvency and the risks on their solvency position arising out of the market conduct. And last but not least, we are talking also about systemic risks, the trust in the financial system as a whole. I have to tell you, I don't know what is Romanian experience, but in late 80s, early 90s in Slovenia, because of the pyramid schemes, the trust in the life insurance has been completely destroyed. Even in socialist times, there has been a small but steady market in life insurance, which has been completely destroyed by the pyramid schemes, and basically the market has had to develop from the start. So when we are talking about the regulation of sales channels, it's not only the relation vis-a-vis the clients, but also, I would say, systemic. It's important for the systemic risks and for the prudential risks. Main features of the IMD2. Basically, we are expanding the IMD1 rules to all the distribution channels. The important thing is how to identify, manage, and mitigate conflict of interest, because we know all that all of our jurisdictions, the sales channels are paid by the commission from the insurers, which presents an essential conflict of interest. The aim of IMD2 is to raise the level of harmonization in sanctioning and measures. We would like to enhance the suitability and objectiveness of the advice given by the sales channels. The aim is to ensure sellers' professional qualifications and to simplify cross-border operations of sales channels. Material issues, proportionality. We have a lot of very small operations and a lot of sales channels which are selling products which don't pose material threats to the clients, such as travel agencies selling travel insurance. In this respect, basically there will be two systems. One will be the registration in the host country, or just a declaration. The sales channels will be under the obligation to disclose full remuneration which will be given by the insurers. Disclosure of any variable remuneration also from the sales personnel employed by the insurers will have to be disclosed. In bundled products, the clients would have to be notified what parts of the product could be acquired on its own. And there will be additional provisions in respect of the insurance investment products in line with PRIPS regulation. Main problems in connection with IMD2. There is no real political will for its adoption. Basically, the sales practices vary so much among the member states that there is a real lack of will for adoption. EIOPA will focus very much now on IMD2. PRIPS initiative has given an additional push for the IMD2, which is a positive thing. And I personally believe it's absolutely necessary for consumer protection and leveling the playing field also for the insurers in the European Union for IMD to be adopted. Coming to PRIPS, which are package retail investment products, basically the regulation is focused on product disclosure and selling practices. And aim is to create consistency for all different PRIPS, and then the rules and the rules are similar to as compared to those in the MiFID directive. PRIPS in connection with insurance. PRIPS initiative is seeking to be applicable to the following products: unit-linked, index-linked life insurance where benefits are partly dependent on the assets chosen by the policyholder, and life insurance with some sort of participation in profits. Basically, we should know that in these classes or in this type of products, the PRIPS will be covering also or touching on insurance business. And now we are coming to the big issue of European Union, which is EIOPA directive, and basically we have wide variety of different pension systems across Europe, and it's very difficult to do some level of common regulation. There is an extremely large number of providers of the occupational pensions, and there is practically no cross-border activity because, or if you want to exercise cross-border activity in the field of occupational pensions, it's extremely complex. The big question, the big political question is, should the clients of occupational pension schemes be afforded at least minimum level of protection such as is in insurance or other savings or investment products? This is the big issue. And I believe yes, the answer of course is yes. Is EU prepared for the single market? I don't know. But it should be leveling the playing field, and it should enhance the competition also in the occupational pensions, which is good for the European consumers in all the EU. The big problem is, of course, in the occupational pensions is how to make a reasonable compromise between keeping a promise and making the system sustainable. Occupational pension, although it's a long-term contract, is still a contract, and contract is nothing but a promise. But if we are talking in such long terms, the crisis has taught us that basically we should really ask whether such long-term contracts can be sustainable. And of course, this is the other side of the coin of the question whether we should talk about defined benefits or defined contributions. In the interest of sustainability, of course, I think the EU will move to defined contributions. But here the role of the system of governance, such as is contained or comparable to the one which is contained in Solvency II, should be designed so that basically the system of governance will make sure that the governance within the providers will make sure that the promises are stood by. And the big problem, of course, with the occupational pensions is that they're closely tied to the tax system. And as we know, there is no light at the end of the tunnel in respect of the tax union. And now to finish, what I would like to say, just to conclude. European insurance industry went through the crisis relatively well. It has not been very much hurt by the crisis. What is important is that the EU, the industry within EU should not become the victim of its own success. Everybody is looking at the huge amounts of assets held by the insurance companies. We should all the time know that the ultimate beneficiaries of these assets are the clients of the insurance companies.